The most dangerous belief in retirement is that the number printed on your Social Security statement is a permanent promise that can never change. The government's own 2026 report now says something far more serious. Under the trustee's best estimate, the Old Age and Survivors Insurance Trust Fund can pay 100% of scheduled retirement and survivor benefits only until the fourth quarter of 2032. After that point, if Congress does not change the law, ongoing income would be enough to cover about 78% of scheduled benefits. That does not mean your check disappears tomorrow. It means a person expecting $2,100 a month could be looking at a gap of roughly $462 a month under that projection. That is $5,544 a year. Over 5 years, that is more than $27,000 missing from a retirement plan that may already be stretched by food, housing, insurance, prescriptions, and taxes. Pay close attention to this because the real risk is not one dramatic announcement. The real risk is a series of quiet rules that reduce what reaches your bank account while you are still being told that your benefit went up. The same official report says the Medicare Hospital Insurance Trust Fund is projected to pay full scheduled benefits until the second quarter of 2033, 1 quarter earlier than last year's projection, and that continuing income at depletion would cover about 89% of scheduled costs. Again, this is a projection, not a notice that hospitals stop accepting Medicare on a certain morning. Congress can act, lawmakers have options, and projections can change. But anyone who tells retirees to ignore an official warning because it is several years away is misunderstanding how retirement damage happens. A retirement plan is not repaired the week before a shortfall. It is repaired years earlier while there is still time to reduce debt, change withdrawal patterns, protect cash reserves, review taxes, and make sure one spouse is not left with a financial structure that only worked while two people were alive. Here is what almost nobody understands. The government did not announce one single event that puts every retiree's money at risk in exactly the same way. It announced and implemented several changes that interact. Social Security benefits increased by 2.8% for 2026. Medicare Part B's standard monthly premium rose to $202.90, an increase of $17.90 from 2025. The annual Part B deductible rose to $283. The retirement trust fund outlook worsened. Federal benefit payments are moving fully toward electronic delivery. Social Security is expanding online collection of overpayments. The IRS is applying a new senior deduction that can help some people, but it is not a separate benefit check and it is not unlimited. Banks continue to monitor cash activity and unusual transfers under federal rules. Retirement accounts eventually force taxable withdrawals. Medicare can use an older tax return to raise current premiums. Each rule by itself may look manageable. Combined, they can quietly remove hundreds or thousands of dollars from a household that thought it was financially safe. Watch how this works with a simple example. A retired worker receives $2,000 a month before Medicare. A 2.8% cost of living adjustment adds $56 a month. That sounds like a meaningful increase. But the standard Part B premium increased by $17.90. The retiree's improvement after that one Medicare increase is now $38.10 a month. Before considering a Part D plan change, a Medicare Advantage plan change, federal income tax, state tax where applicable, higher property insurance, food, electricity, or prescription costs, the public hears that Social Security went up by 2.8%. The bank account experiences a smaller number. This is happening quietly, and it is one reason retirees feel confused when an announced increase does not create more breathing room. I have spent decades studying the way these systems connect, and I want to be precise. Social Security is not a personal savings account with your name on a box of money. Current payroll taxes, taxes on some Social Security benefits, and trust fund interest help finance current payments. The trust funds hold special Treasury securities backed by the United States. When annual program costs exceed annual income, reserves are used. In 2025, according to the 2026 Trustees Summary, the Old Age and Survivors Insurance Fund's cost exceeded its income by $200 billion. That does not mean the system is empty. It means the reserve is moving in the wrong direction, and every year of delay reduces the number of painless solutions available. The Federal Reserve is not sitting in a room deciding whether your personal grocery purchase looks suspicious. That is not how the mechanism works. The Federal Reserve influences the cost of money through monetary policy and supports major parts of the payment system. Banks, card companies, credit bureaus, the IRS, Social Security, Medicare, and the Treasury operate through different legal systems, but their records can affect one another. Your tax return can influence Medicare premiums. Your wages can influence Social Security withholding before full retirement age. Your bank's fraud system can delay a transfer. A late credit card payment can damage borrowing power. A retirement account distribution can increase taxable income, make more Social Security taxable, and push Medicare premiums into a higher bracket later. The enemy is not one person. The enemy is the invisible connection between rules that were designed separately but land on the same household budget. The first major revelation is this: a cost of living adjustment can increase your gross benefit and still leave you financially weaker. Most people look only at the new Social Security number. They do not calculate the net deposit after Medicare, tax withholding, debt payments, and inflation in the expenses they actually buy. The official COLA uses the Consumer Price Index for urban wage earners and clerical workers, known as the CPIW, comparing third-quarter data. It is a broad formula. It does not know that one retiree spends heavily on insulin, another on homeowners insurance, another on rent, and another on helping an adult child. A national percentage can be mathematically correct and personally inadequate at the same time. Imagine a widow named Carol in Ohio. She receives $1,180 a month in Social Security. Her 2.8% adjustment adds just under $50 a month. Her Part B premium rises by $17.90. Her supplemental insurance rises by $22. Her property tax escrow rises by $31. Her gross benefit increased, but her monthly position weakened. Carol did not make a reckless investment. She did not buy a luxury car. She did not gamble. She experienced the arithmetic of three systems moving at different speeds. This is the identity of millions of people watching right now. A worker who did what was expected, saved what was possible, paid taxes for decades, and still feels as though the ground is moving under every careful decision. That is why I do not want you to think only in terms of income. Think in terms of protected cash flow. Income is the number before deductions and surprises. Protected cash flow is the amount that remains available after unavoidable costs and after you have created a buffer for irregular expenses. A retiree with $4,500 a month and no emergency reserve can be more fragile than a retiree with $3,300 a month, low fixed expenses, no credit card balance, and 6 months of essential costs in cash. This helps both lower-income retirees and comfortable middle-class retirees because the size of the numbers changes, but the mechanism does not. Now we come to a tax rule that has punished retirees quietly for decades. Social Security benefits can become taxable based on what the tax code calls combined income, sometimes described as provisional income. The basic thresholds are still extremely low compared with modern living costs. For an individual, combined income above $25,000 can cause up to 50% of benefits to be included in taxable income, and above $34,000, up to 85% can be included. For a married couple filing jointly, the comparable thresholds are $32,000 and $44,000. Those thresholds are not indexed for inflation. That one detail changes everything. It does not mean the government takes 85% of your Social Security. That is a common misunderstanding. It means up to 85% of the benefit can be included when taxable income is calculated, but the practical result can still hurt. A retiree takes an extra $12,000 from a traditional IRA to replace a roof. That distribution may be taxable. It may cause more Social Security to become taxable. It may increase the marginal tax on the withdrawal. And because Medicare generally looks back to earlier tax information, that same year may also influence a future Medicare premium. One roof payment can touch three systems: the IRA, the taxation of Social Security, and Medicare. Consider Robert and Elaine, both 72, living in Pennsylvania. Their Social Security totals $48,000 a year. Robert has a small pension of $18,000. They withdraw $22,000 from a traditional IRA for ordinary living expenses. Then they take another $35,000 to help a daughter after a divorce. They believe they simply moved their own money from one account to another. The IRS sees taxable distributions. Their tax preparer sees a larger adjusted gross income. Medicare may later see modified adjusted gross income from that tax return. The family gift may have been generous and completely lawful, but the timing created a tax wave that reaches beyond the year of the withdrawal. Nobody is going to tell you about this at the moment you click the distribution button. The brokerage may warn about withholding, but it usually will not calculate your Social Security taxation, your state rules, your future IRMAA, your Affordable Care Act effect if a younger spouse is not yet on Medicare, or the loss of another income-based benefit. This is not automatic. You have to model the transaction before taking the money, especially when the distribution is large and voluntary. The government also created an additional deduction for many people aged 65 and older for tax years 2025 through 2028. An eligible person may be able to claim an additional $6,000 deduction or $12,000 for a married couple filing jointly when both spouses qualify. It can be used by eligible taxpayers who take the standard deduction or itemize. But it begins to phase out when modified adjusted gross income exceeds $75,000 for an individual or $150,000 for a joint return. Most people think they do not qualify, while others wrongly assume every senior automatically receives $6,000 in cash. Both beliefs are dangerous. A deduction is not a dollar-for-dollar payment. If a person in a 12% federal bracket receives a full $6,000 deduction, the rough federal tax effect could be around $720. Depending on the rest of the return. If a married couple qualifies for $12,000 and is in a 12% bracket, the rough effect could be around $1,140. That can be valuable, but it is not a $12,000 refund, and it does not mean Social Security is no longer taxable. The deduction reduces taxable income under the rules. You have to claim it correctly. This is not automatic in the sense that no government employee will call you and make sure your return uses every benefit available. This is where a quiet error can cost more than an obvious fee. A retired couple may use the same simple tax method they have used for 10 years. They may not tell the preparer that one spouse turned 65 before the end of the tax year. They may assume a new deduction is built into every return without checking. They may file too early with incomplete forms, or they may hear a political slogan about no tax on Social Security and stop withholding, only to discover that the actual law created a deduction with eligibility limits rather than a universal exclusion of benefits. Words used in public debate are not the same as the instructions on a tax return. If this information is helping you see how these rules connect, leave a like so more retirees and families can find a calm explanation before a preventable mistake reaches their bank account. The next revelation is Medicare's 2-year shadow. Many retirees believe Medicare looks at current income. Often it uses tax information from 2 years earlier. For 2026 premiums, Social Security generally uses 2024 tax return information when determining the income-related monthly adjustment amount, known as IRMAA. For 2026, the standard Part B premium is $202.90. An individual with modified adjusted gross income at or below $109,000, or a married couple at or below $218,000 generally pays that standard amount. Cross the first threshold, and the total Part B premium rises to $284.10 per person. Move into the next tier, and it rises to $405.80. Higher tiers reach $527.50, $649.20, and $689.90 per person per month. Part D can add a separate income-related amount on top of the drug plan premium. Think about the impact of this. A married couple can cross an income line because of one large IRA withdrawal, a property sale, a Roth conversion, a severance payment, a capital gain, or the sale of appreciated investments. 2 years later, both spouses may receive higher Medicare charges. At the first Part B IRMA tier, the additional amount is $81.20 per month for each spouse. That is $162.40 a month for the household, or $1,748.80 over a year before the Part D adjustment. A decision made in one tax year can quietly create a premium penalty feeling in another year, even though IRMA is legally an income-related adjustment, not a punishment. Here is what almost nobody understands. IRMA uses modified adjusted gross income, and for this purpose it generally includes adjusted gross income plus tax-exempt interest. A retiree may believe municipal bond interest cannot hurt because it is exempt from federal income tax. It may still count in the Medicare calculation. A transaction can be tax-exempt for one purpose and still matter for another. This is why financial planning by labels fails. Tax-free does not always mean consequence-free. Now imagine James, a 67-year-old veteran in Arizona. In 2024, he sold a rental property and recognized a large gain. In 2025, his income fell sharply because he stopped working and no longer had rental income. In 2026, he receives a Medicare notice based on that older, higher tax year. He feels punished for income he no longer earns. But a work stoppage or certain other life-changing events can allow a person to request a new decision using Form SSA 44. Retirement, marriage, divorce, death of a spouse, loss of income, producing property under qualifying circumstances, loss of pension income, and certain employer settlement payments can matter. The details are specific, documentation matters, and approval is not automatic. You have to claim it. Most people think they do not qualify because they assume a Medicare premium notice is final. This is one of the clearest examples of the system favoring the person who understands the procedure. Two retirees can have the same current income and the same old tax return. One pays the higher premium for a full year because he assumes nothing can be done. The other documents a qualifying life-changing event, files the request, and receives a lower determination. Nobody is going to tell you about this in a personal phone call. The notice may mention appeal rights, but frightened people often read only the amount due. There is also help on the lower income side that many people miss. Medicare savings programs can pay some or all of certain Medicare costs for eligible people. In 2026, the federal monthly income limit shown for the Qualified Medicare Beneficiary Program is $1,350 for an individual and $1,824 for a married couple, with resource limits of $9,950 and $14,910, though states can use different or more generous rules. The specified low-income Medicare beneficiary program shows higher income limits, and the qualifying individual program goes higher again. The QI program requires a new application each year, and states process it on a first-come, first-served basis, giving priority to prior recipients. This is not automatic. You have to claim it. People hear the word Medicaid and assume they own too much, earn too much, or will be treated badly. Most people think they do not qualify. Some are correct, but many never apply and never receive an official determination. A person paying $202.90 a month for Part B is spending $2,434.80 a year. For a low-income retiree, getting that premium paid can be the difference between buying food with cash and carrying groceries on a credit card. This helps both lower-income retirees and comfortable middle-class retirees, because the first group may qualify for direct assistance while the second group can benefit from understanding IRMAA and tax timing. Now let us move to Social Security's earnings test, because it creates some of the most frightening benefit notices. If you are younger than full retirement age for all of 2026, Social Security's earnings limit is $24,480. The agency generally withholds $1 in benefits for every $2 of wages or net self-employment income above that limit. In the year you reach full retirement age, the limit is $65,160 for the months before the month you reach full retirement age, and the general withholding is $1 for every $3 above the limit. Once you are at full retirement age for the entire year, there is no earnings limit for retirement benefits. The critical detail is what counts. Wages and net earnings from self-employment generally count. Pension income, annuity income, interest, investment earnings, and capital gains generally do not count for this earnings test. People confuse the Social Security earnings test with income tax rules and Medicare rules. The same dollar can count under one system and not another. A bank certificate of deposit may produce taxable interest and may affect Medicare income, but it is not wages for the Social Security retirement earnings test. A part-time job is wages. A traditional IRA distribution can be taxable, but it is not wages for this test. One word, income, hides several different legal definitions. Consider Linda, who claimed Social Security at 62 and returned to part-time work because her rent increased. She expects to earn $30,180 in 2026, exactly $6,000 above the annual limit. Under the basic rule, Social Security may withhold $3,000 of benefits. Linda sees a missing payment and believes the money was stolen forever. In many cases, benefits withheld under the earnings test can later lead to a recalculation at full retirement age, crediting months in which benefits were withheld. But that later adjustment does not solve this month's rent problem. The long-term accounting may improve while the short-term cash flow becomes dangerous. There is also a special monthly rule that can help in the first year of retirement when someone earned above the annual limit before stopping work. In 2026, a person younger than full retirement age for the entire year can generally be considered retired for a month if monthly earnings are $2,040 or less, subject to the detailed rules. This is exactly the kind of provision nobody explains at the retirement party. A worker retires in August after earning $70,000 from January through July. Looking only at the annual number makes it appear that all benefits should be withheld. The special first-year rule may allow full checks for whole months considered retired. This is not automatic unless Social Security has accurate information. You have to report the change and understand what the agency is using. The next issue is the government's full movement toward electronic payments. Social Security announced in June 2026 that it plans to complete the transition to electronic payments for all beneficiaries during the year. Federal law and Executive Order 114247 required federal benefits to be paid electronically as of September 30, 2025, with limited waiver possibilities. Social Security says paper checks are 16 times more likely to be lost, stolen, altered, or returned as undeliverable than electronic payments. The security argument is real. Check theft is real. But the transition creates a different danger for people who do not control their digital identity. The risk is not that direct deposit is inherently unsafe. The risk is that your benefit now depends on correct account information, correct identity records, access to a phone or email when verification is needed, and your ability to recognize a fraudulent request. A paper check could be stolen from a mailbox. A direct deposit can be redirected if a criminal successfully takes over an account or convinces a beneficiary to change banking details. The method changes, but vigilance remains necessary. Picture Frank, 78, in rural Kentucky. His daughter helped create his online account years ago using an email address he no longer checks. He changes banks after a branch closes. A caller claiming to be from Social Security tells him there is a problem with his direct deposit and asks him to confirm a one-time code. Frank sees the agency name on the caller ID and cooperates. The code was actually a key to his account. The criminal changes information. Frank does not discover the problem until the expected deposit is missing. The system did not target Frank. A criminal used the system's speed and Frank's trust against him. Protecting electronic benefits begins with a boring practice that many people resist. Maintain control of your own contact information. Know which email address is connected to your Social Security account. Use a strong password that is not reused at the bank. Never give a one-time security code to an incoming caller. Verify notices by typing the official address yourself or using a trusted saved bookmark, not by clicking a link in a text message. Review direct deposit information after any bank merger, account closure, divorce, death, or change in the person who helps manage finances. If you do not have a bank account, the Treasury-sponsored Direct Express program may be an option. If you genuinely cannot transition because of qualifying circumstances, a waiver may be possible. Again, this is not automatic. Social Security also announced in July 2026 that people who receive an overpayment notice can repay online using pay.gov or the Treasury's online bill pay process. More than 80% of people receiving an overpayment notice choose to pay online, according to the agency. That convenience is useful, but an overpayment notice is emotionally powerful. A retired person sees a government letter demanding $4,800 or $14,000 and feels the room get smaller. Fear makes people move too quickly. Do not confuse a notice with the end of your rights. Verify that the notice is real. Read the stated reason and dates. Compare the payment history with bank records. Understand the deadline to appeal or request a waiver when applicable. Do not send money to a caller, a gift card, a cryptocurrency address, or a personal payment account. Official online repayment methods require the remittance information connected to the notice. A legitimate debt can still contain an error in amount, period, or responsibility. Paying immediately may feel safe, but it can make a disputed case harder to manage if you have not first preserved your records. This is the emotional center of the problem. People who worked for 40 years are being asked to manage retirement through systems designed around portals, codes, tax definitions, appeal windows, income tiers, and automated notices. A widow may be grieving while an IRMA notice arrives. A veteran may be recovering from surgery while a bank flags a transfer. A couple may be trying to protect a disabled child while an inherited IRA deadline approaches. These are not careless people. They are tired people facing rules that do not slow down when life becomes difficult. The feeling of being watched financially is not imaginary, but it must be understood correctly. Banks are required under the Bank Secrecy Act to keep records and report certain activity. Cash transactions exceeding $10,000 in one business day generally trigger a currency transaction report, and related cash transactions can be aggregated. Banks also maintain systems for detecting suspicious activity. This does not mean a legal $12,000 cash deposit is automatically taxed, seized, or treated as a crime. It means the transaction may be reported. The dangerous mistake is trying to avoid reporting by intentionally splitting cash into smaller deposits, a practice commonly called structuring. A person can turn innocent money into suspicious behavior by attempting to hide the pattern. Imagine a retired contractor named Miguel, who kept $28,000 in a home safe from years of legitimate, already taxed savings. He wants to deposit it before moving to assisted living. A neighbor tells him never to deposit more than $10,000. So Miguel deposits $9,000 on Monday, $9,000 on Wednesday, and $10,000 on Friday. He believes he is staying under a tax limit. In reality, he may create a pattern that looks designed to evade reporting. The better path is honest documentation and a direct conversation with the bank before making an unusual cash deposit. Explain the source. Keep records. Deposit the amount in a transparent manner. A reporting form is not a tax bill. Banks also use automated fraud systems that compare a transaction with your normal behavior. A retiree who normally pays local bills may suddenly wire $85,000 to a new account after receiving instructions by email. The bank may delay the wire, ask questions, or refuse it. That can feel insulting, but it may be the last barrier between the retiree and a permanent loss. At the same time, automated systems make mistakes. A legitimate transfer to buy a home, help a child, or move retirement assets can be delayed because the pattern is unusual. The smart response is not rage and not secrecy. It is preparation. Contact the institution through a verified number. Ask what documents are needed. Confirm wiring instructions by a second channel. Never trust a last-minute email that changes the destination account. The Treasury's 2026 National Risk Assessment described criminals using artificial intelligence to create fake profiles, cloned voices, identification documents, and convincing messages. It also described government use of enhanced processes, including artificial intelligence, to identify potentially fraudulent check activity. That is the new financial environment. Criminals use automation to imitate trust. Institutions use automation to detect risk. Ordinary people stand in the middle, sometimes protected and sometimes delayed. Most people never realize this until a payment is frozen or a familiar voice on the phone asks for money. A voice that sounds like your grandson is no longer proof that your grandson is speaking. A video image is no longer proof that the person is live. A caller ID is no longer proof of origin. Families need a private verification method that is not stored in public social media. A simple family word, a callback rule, or a requirement that any emergency request be verified with a second relative can prevent a devastating transfer. Do not let embarrassment stop you from checking. Criminals depend on urgency, secrecy, and emotional isolation. Now tell me in the comments, did you already know that the same retirement withdrawal can affect taxes and Medicare without counting as wages under the Social Security earnings test? Or is this the first time someone has separated those rules clearly? Now consider credit. Retirement does not remove the importance of a credit profile. Even a person who plans never to borrow again may need credit for a vehicle, a medical payment plan, an apartment, insurance pricing in some states, utilities, or emergency home repairs. Credit scoring systems are not moral judgments. They are risk models built from reported behavior. A single missed due date may create a fee immediately, and a payment that becomes seriously late can be reported and damage the profile. High card balances can also make a borrower appear more dependent on credit, even when every payment is made on time. The invisible retirement error is using a credit card as an income bridge without naming it. A retiree's checking account runs short by $600 each month, so groceries and prescriptions go on a card. The minimum payment is made. The balance rises slowly from $2,000 to $9,000. There was never one dramatic purchase, only a monthly budget gap disguised as convenience. At an interest rate above 20%, the card can consume years of careful savings. The Federal Reserve can raise or lower policy rates, but a card issuer's pricing, the borrower's terms, and market conditions determine what the household actually pays. Retirement debt is dangerous because there may be no future wage increase to absorb it. A practical way to expose the problem is to calculate the monthly operating deficit without credit. Take the deposits that reliably arrive. Subtract housing, utilities, food, insurance, transportation, taxes, healthcare, required debt payments, and realistic irregular costs divided by 12. If the result is negative, the card is not the problem, it is the symptom. The solution may require a housing decision, a work decision, a benefit review, assistance programs, debt restructuring, or a controlled retirement withdrawal. Pretending the deficit is temporary while adding interest makes every future option smaller. The next retirement trap sits inside the account people trust most, the traditional IRA or 401k. Tax deferral is valuable, but deferred tax is not erased tax. At age 73, many account owners must begin required minimum distributions. The first distribution can generally be delayed until April 1st of the year after the year the person reaches 73, but delaying the first one can force two taxable distributions into the same calendar year, the delayed first distribution and the second distribution due by December 31st. That can increase taxable income, make more Social Security taxable, and raise future Medicare premiums. Suppose Susan turns 73 in 2026 and has a required minimum distribution of $28,000 for 2026. She delays it until March 2027. Her 2027 required distribution is $30,000 and must also be taken by December 31st, 2027. She now has $58,000 of required distributions in one tax year. If she had taken the first $28,000 during 2026, she might have spread the income across two returns. Delaying was legal, but legal does not mean financially wise. The penalty for missing a required minimum distribution can be serious. Current rules generally impose an excise tax of 25% on the amount not taken, potentially reduced to 10% if corrected within the permitted correction window. Form 53229 is used to report certain retirement account additional taxes and request relief where available. Most custodians provide calculations, but the legal responsibility ultimately rests with the account owner. This is not automatic. The institution holding one IRA may not know about another IRA, an inherited account, an old 401k, or a special beneficiary rule. Roth accounts create another source of confusion. Roth IRAs and designated Roth accounts in plans generally do not require lifetime distributions for the original owner under current rules. But a Roth conversion can create taxable income in the conversion year. A 68-year-old converts $150,000 from a traditional IRA to a Roth account and is pleased that future growth may be tax-free if the requirements are met. 2 years later, Medicare charges a much higher premium because the conversion increased modified adjusted gross income. The conversion may still have been a good long-term decision, but nobody should discover the Medicare effect after the notice arrives. This is why retirement withdrawals should be scheduled like medical procedures, not treated like ATM visits. Before a large distribution, identify the tax year, filing status, expected Social Security, pensions, interest, dividends, capital gains, charitable giving, Medicare status, age, and whether a spouse will enroll in Medicare within 2 years. Estimate the effect at several withdrawal amounts. Sometimes taking $40,000 in December and $40,000 in January is better than taking $80,000 in 1 year. Sometimes the opposite is true because a deduction, tax rate, market loss, or life event changes. This content is educational and does not replace personal financial, legal, tax, or accounting advice. The point is to know which professional question to ask before the transaction becomes permanent. The inheritance trap is even more dangerous because grief destroys attention. Many non-spouse beneficiaries of retirement accounts are subject to a 10-year rule that requires the inherited account to be emptied by the end of the 10th year after death, with important exceptions and additional annual distribution requirements in some cases. A beneficiary hears 10 years and assumes no action is needed until year 10. Depending on the original owner's age and the beneficiary category, annual required distributions may also apply. Waiting can concentrate a large taxable balance into the final years. Imagine 2 adult children inherit a $600,000 traditional IRA from their father. One child earns $55,000 a year. The other earns $220,000. An equal withdrawal schedule may be simple, but it may not be tax efficient for either. The lower income child may have room to take more earlier at lower rates. The higher income child may want to coordinate distributions with retirement, a sabbatical, charitable planning, or a business loss. The account must follow beneficiary rules, titles must be correct, and inherited IRAs generally cannot be treated like the beneficiary's own IRA unless the beneficiary is a surviving spouse using permitted options. One wrong rollover can create a taxable distribution that cannot be reversed easily. Inheritance tax language also causes fear. The federal estate tax applies only above a high exemption, which is $15 million for 2026 under current law, although state estate or inheritance taxes may apply at lower levels depending on location and relationship. The annual federal gift tax exclusion is $19,000 per recipient in 2026. Giving more than that does not automatically mean the recipient owes income tax, or that the donor immediately writes a gift tax check. It can create a reporting requirement and use part of the donor's lifetime exemption. The form, basis, control, Medicaid planning consequences, and state rules can matter more than the headline number. A parent may give a child a house during life to avoid probate, not realizing the child may receive the parent's carryover tax basis. If the child inherits appreciated property at death, the basis may generally adjust to fair market value under federal rules. The difference can create a large capital gains consequence later. But estate planning is not one size fits all. Medicaid eligibility, creditor exposure, family conflict, second marriages, special needs planning, and state law can change the answer. Nobody is going to tell you about this at the county recorder's counter. A deed is short. Its consequences can last decades. The quietest risk is not a tax rate. It is the loss of control when one spouse dies or becomes incapacitated. In many households, one person knows every password, every account, every automatic payment, every insurance contact, and every tax detail. The other knows that money arrives and bills are paid. That system looks efficient until the knowledgeable spouse is in a hospital. Then the survivor is surrounded by locked phones, two-factor authentication codes, missing beneficiary forms, old employer plans, and bank employees who legally cannot take instructions from someone who lacks authority. If you want to continue receiving explanations like this, consider subscribing to the channel and turning on notifications so you do not miss the next video when another rule changes quietly. A protective household keeps an organized financial map. It identifies institutions, account types, beneficiaries, trusted contacts, insurance policies, recurring bills, debts, income sources, tax professionals, attorneys, and the location of legal documents. It does not need to expose passwords carelessly. It needs to make access possible through lawful, secure instructions. Durable powers of attorney, healthcare documents, wills, trusts where appropriate, and updated beneficiary designations should work together rather than contradict one another. A will does not control every asset. Retirement accounts and life insurance usually follow beneficiary designations. Joint ownership and transfer on death arrangements can override expectations. This is not automatic. You have to claim control while you are healthy enough to create it. Now we reach the strongest revelation. The government's 2026 warning is not only that one trust fund may reach depletion in 2032, the deeper warning is that the retirement system can remain fully operational while the individual retiree loses purchasing power, pays more for Medicare, triggers more taxable income, receives an overpayment demand, experiences a bank hold, and misses a claim that could have reduced the damage. The machinery does not need to collapse to hurt you. It only needs to keep moving while you misunderstand how the gears connect. Visualize the system at work. At midnight, a bank's monitoring software compares a transfer with thousands of earlier transactions. A Social Security database applies an earnings limit to reported wages. The IRS stores a tax return containing IRA distributions, capital gains, and tax-exempt interest. Medicare uses tax data from 2 years earlier to calculate a premium tier. A brokerage calculates a required distribution from a December 31st balance. A credit card system adds daily interest. A Treasury payment file sends benefits electronically. None of these systems knows that the retiree's spouse died, the roof failed, the daughter needed help, the bank branch closed, or the tax preparer misunderstood a new deduction unless the correct information enters the correct process at the correct time. That is the silent surveillance people feel. It is not one all-seeing machine judging your life. It is a collection of separate systems observing fragments. Wages, deposits, tax forms, balances, claims, payment history, identity signals, and account behavior. The danger comes when the systems can see the transaction but cannot see the human reason behind it. Your protection is documentation, timing, verification, and the willingness to challenge a wrong result through the proper channel. The 2026 Trustees Report says the Old Age and Survivors Insurance Fund is projected to pay full scheduled benefits until the fourth quarter of 2032, then about 78% from continuing income if no legal changes occur. The combined Social Security projection, often discussed publicly, shows full scheduled benefits until the third quarter of 2034 and about 83% payable at depletion. But the two funds cannot actually be combined without a change in law. Those are not identical statements. Precision matters. A frightening headline may use the 83% number. A retirement and survivor household may be more directly exposed to the separate OASI projection. Congress may act before either date, but hoping that lawmakers act is not a personal financial plan. A reasonable plan does not assume a 22% cut will certainly happen, and it does not assume benefits can never change. It stress tests both possibilities. Take the expected net Social Security benefit, not the gross number. Calculate what the household would do with 10% less, then 15% less, then the projected 22% gap. Identify which expenses could change and which cannot. Decide whether debt should be reduced faster, whether claiming should be reconsidered, whether part-time work is realistic, whether a smaller home is necessary, whether insurance coverage is efficient, and whether retirement withdrawals are being used in a tax-aware order. For a married couple, model the survivor year. When one spouse dies, one Social Security payment usually disappears, while many household expenses remain. Tax filing status may change from married filing jointly to single. Medicare. IRMAA thresholds are lower for a single filer than for a joint couple. The standard deduction changes. The survivor may move into a higher effective tax position even with lower household income. A couple living comfortably on $6,000 a month may assume the survivor will live on $4,500. But after one benefit disappears, the survivor may have $3,700 while still paying most of the housing, insurance, transportation, and maintenance costs. For a person near retirement, the strongest protection may be one more year of work, but not always. Another year can add wages, retirement contributions, health coverage, and a larger Social Security benefit if claiming is delayed. It can also cost time, health, or caregiving opportunities. The 2026 contribution limit for many 401k, 403b, and governmental 457 plans is $2,500, with a general catch-up limit of $8,000 for eligible workers age 50 or older, and a higher catch-up limit of $11,250 for workers who turn 60 through 63 during the year in many of those plans. These limits are opportunities, not commands. A person carrying a 24% credit card balance may need a different priority than a person with no debt and substantial cash reserves. For a current retiree, the strongest protection may be claiming something already available. Review whether the new senior deduction was used correctly. Review whether Medicare savings programs or extra help may apply. Review an IRMAA notice after retirement or another qualifying event. Review the Social Security earnings test if benefits were withheld. Review survivor, spousal, divorced spouse, or dependent benefits where relevant. Review tax withholding so April does not produce a shock. Review beneficiaries and powers of attorney. Most people think they do not qualify. Nobody's going to tell you about this one household at a time. You have to claim it. For a comfortable middle-class retiree, the strongest protection may be controlling taxable income across several years. Do not take a large IRA distribution without measuring Medicare. Do not sell appreciated assets without checking capital gains and state tax. Do not convert to Roth only because a television expert said tax rates may rise. Do not keep every dollar in pre-tax accounts until required distributions force the timing. Do not keep excessive cash in an uninsured structure without understanding FDIC coverage categories. Do not assume a financial technology app is identical to a directly insured bank account. Ask who actually holds the deposit, how ownership is recorded, and whether coverage applies in the specific structure. For a lower-income retiree, the strongest protection may be refusing shame. Assistance programs exist because Congress created eligibility rules, not because applicants failed. A Medicare premium paid by a savings program can release more than $2,400 a year. Prescription extra help can reduce drug costs. Energy, food, property tax, and state programs may exist. Rules differ by state, and some programs exclude certain assets or use special counting methods. Applying is not surrender. It is using a system you helped finance. Do not make sudden moves because of this warning. Do not empty a retirement account. Do not withdraw cash and store it at home. Do not stop Medicare. Do not stop tax withholding blindly. Do not give assets away without advice. Do not answer a caller who says your Social Security number is suspended. Urgency should produce organized action, not panic. The system benefits when people either ignore rules completely or react emotionally. Protection lives in the middle. Calm, documented, timely decisions. Start with the next 90 days. Obtain the current Social Security benefit verification and review the net deposit. Compare it with the Medicare deduction. Read the latest tax return and identify adjusted gross income, tax-exempt interest, IRA distributions, capital gains, and the amount of Social Security included in taxable income. Check the year used for any IRMAA notice. Confirm direct deposit information through an official account or verified number. List every retirement account and identify whether an RMD applies. Review credit card rates and balances. Confirm beneficiaries. Put important contacts and documents where a trusted person can find them lawfully. Then look 5 to 10 years ahead. Estimate income after one spouse dies. Estimate required distributions at 73. Estimate the effect of a possible Social Security shortfall without treating it as certain. Consider whether the house, vehicle, insurance, and debt structure still fit the future household. Decide which assets are for living, which are for emergencies, and which are intended for heirs. Money without a job becomes emotionally available for every request. Money assigned to healthcare, housing, taxes, and survival is easier to protect. I want to speak directly to the person who feels betrayed. You paid into Social Security. You saved in a 401k. You trusted the bank. You paid Medicare premiums. You filed tax returns. You did what responsible people were told to do. The fact that the rules are complicated does not mean you were foolish. It means the system often places the burden of understanding on the person with the least time, least energy, and most to lose. But you are not powerless. The new government report is a warning, not a sentence. A projection can lead to legislation. A Medicare adjustment can sometimes be challenged. A deduction can be claimed. An assistance program can be requested. A fraudulent transfer can be prevented. A required distribution can be planned. A beneficiary form can be corrected. A survivor can be prepared. Small actions taken before a crisis are worth more than perfect explanations after the money is gone. Remember the central lesson. This is not automatic. A benefit increase does not automatically increase your real spending power. A new tax deduction does not automatically appear as cash. A Medicare appeal does not file itself. A savings program does not enroll every eligible retiree. A bank does not know the human story behind an unusual transfer. A retirement custodian does not coordinate every account. An inheritance plan does not update itself after a divorce, death, or remarriage. You have to claim what helps you, document what is unusual, and plan what can hurt you. Share this video with a spouse, parent, veteran, widow, co-worker, or friend who believes the number on a benefit statement is all they need to know. Protecting someone does not always require giving them money. Sometimes it means giving them the rule before the deadline. And if you think this warning is important, watch the next video appearing on the screen now. In it, I explain another quiet situation that can directly affect the money of millions of retirees and why the people who act before the notice arrives usually have more options than the people who wait.